Testing 1, 2, 3, and it looks like we're live. Alrighty. If you want to participate or have any questions, just go to the comment section. I think I'm pointing in the right direction, right over here, or it might be down below, depending on whether or not you're on a computer or on a mobile device. I've actually never used YouTube streaming live with a mobile device, so I have no idea how that works. If you want to make comments or participate in the live commenting. But anyways, today is Sunday, February 27th, and tomorrow's the last day of trading in February. And this is the 0DTE retrospective, which is the culmination or the final ceremony in an iterative process that we call continuous improvement. So what we do in this larger process that kind of encompasses everything is that we have 3 events every week. And each of those trading events, Monday, Wednesday, and Friday, the 0 day for expiration or the last day of expiration of the respective contracts, is that we go through a process that makes up our strategy. It's a system. And it's fairly regular. I mean, we do analysis, or I do analysis, or I lead the analysis of the market structure, and also do an analysis of the potential energy that's coming into the market. The market structure will give us, through volume profile, a landscape, so to speak, of what the market looks like, so that once we know the energy that's coming into the market, in other words, the direction and magnitude of price from the start of the day, then we can fairly accurately predict how price will interact with the market structure. So for instance, it tends to gravitate towards volume nodes. At the edge of nodes, particularly ones that are very steep, that acts as support or resistance. And then when we break through that and enter a volume well, price tends to move very quickly through the well. Usually at the very bottom part of that well, there is some kind of inflection point or resistance, and price is either rejected back to the original node or it will scoot through to the next node. Now, what I described there is really how the market moves. It's either trending or consolidating, or trending and range bound, I guess is another way to say it. During the day, we really don't know whether it's going to be, from the outset, whether it's going to be a trending or a range bound day. Sometimes you have a pretty good idea by looking at the futures market and where it came from and maybe the momentum that it is gathered, or if you then rely on catalysts to the market, things like economic reports, news events, Fed speak, anything else that happens prior to the market open or just after the market open that can influence the market or change its trajectory, its vector, its direction and magnitude of direction. So that's what we're trying to find out. That's what I refer to as energy. So when I say vector, price vector, that is always talking about the price direction or the bias that we have and how powerful it's moving in that direction. There are other things that we use to determine price direction and magnitude of direction, or its potential during the day. We look at expected move, for instance, which is nothing more than a statistical look at the way price has been moving in the most recent past and what its expected move is that day. And all that really does is give us a range. It doesn't tell us direction. We can also look at things like open interest and volume in the options chain, and that is in a way coincident or overlaps or is the same thing as the volume profile. But from that we can determine, where a market might gravitate towards. And a lot of people refer to that as the max pain areas of an options chain. So all of these things we use to kind of determine market bias and direction, or magnitude of that direction, magnitude of that bias. Once we've kind of come to that conclusion, we want to model that in an options trade. And we generally use butterflies, and we try to do it in such a way that we anticipate where price might go and either end up by the end of the day, or find a place where it will be range bound, so that we can place a premium collection strategy there, typically a butterfly, and take advantage of the exponential decay of premium on the last day of expiration. That, in general, is our strategy. And of course, once we've executed the strategy that we modeled based on our analysis, we then try to manage our profits, or manage how we're going to extract premium the most efficient way, or once we feel like we've got what we need or can potentially get, or go for the big kahuna and possibly pin a trade that day. So as you can tell, this requires a lot of discretion, but also knowledge of various disciplines and methods, understanding of volume profile, understanding of options, understanding of economic reports, the geopolitical situation, the financial situation, all of these things. It also requires that you have very good execution skills with your platform. You should understand how to use your platform. It doesn't really require us to be like fleet of foot and everything is like a video game or anything like that. We generally make a decision, place a trade, see how it develops, exit the trade. So that's what we do during the day. And then there's 3 of those events, and then at the end of the week, we have this meeting where we talk about the trades that we did, look at what went right, what went wrong, and is there anything that we can do to improve our strategy going forward. So that encapsulates this sort of iterative week. So there are 3 iterations during the week, then a bigger iteration of the week that is ended with a retrospective. Now, one thing that I've found, and we've been doing this now since last April, and overall it's been very, very successful. We had a rough spot when we came into January and the beginning of February. Very different from what we had before that. Now it seems to be climbing out of that, and it looks like we're going to end up where we were last year, starting in April, then going into the summer and having a very strong trading season. Now, one thing that has happened over that time is that we've developed the process and the strategy and how I conduct business, and the channels that we have all been renamed or reorganized, and the type of information that I put out there, how I segregate the analysis from all the chit-chat that happens in the talk. All of those things are things that have been continuously improved over time. Now, I believe that there's still lots of room for improvement, and one of the areas of improvement I think that needs to be made is a better accounting for what happened each trading day, so that when we get to this day today, our retrospective, it can be more meaningful. And I asked the group in the Discord, if they would consider this, and they thought it was a good idea. I gave some ideas, and I think everybody was in general agreement that it would be good to have a mini retrospective at the end of each day that kind of recaps what we did that day, and then put it down or archive it so that it can then later be referenced or gone over just to see how it did. Maybe even provide some kind of grading to the various activities that we did during that day. You know, the analysis, the trade position, the way we manage the profits, all of that stuff. Now we have 3 of these things that we can then take to the retrospective and look at it as in a more objective way. And then maybe at the end of a month, you can then look at the retrospective, sort of bubble all that information up and see how we do, and then be able to track and go back and say, hey, this is the performance that we had, and these are the changes that we made, this is what we encountered, etc. And it will provide a very rich set of information that we can use. So up to this point, it hasn't really been that way. All we do is really record the retrospectives, and then you can go back. And even the retrospectives themselves could probably, when I edit them and put them up on the website, perhaps there could be some sort of, these are ideas that I'm throwing out there, by the way. Perhaps there could be some sort of legend or table of contents showing the times that we addressed this topic or that topic or that topic. So these are ideas that I have, and I wanted to discuss these with you on ways that we can change and make this better. Because, you know, as you know, this is not just an alert service. An alert service is like the least of what I'm trying to accomplish here. What I'm really trying to accomplish here is, as a coach and a mentor, show you this very strong strategy that has proven itself over many, many months. Sure, it has some times where the market just doesn't give us what we want, but most of the time it's just fantastic. And teach people this strategy and get you to a level of proficiency that you can make it your own. That's the whole purpose of this service. And so I think that making some of these changes, like the daily review of a trade and then grading it, and then maybe doing, at the end of the day, maybe a 10 or a 15-minute video, a streaming video, a live video, where we grade each aspect of it very objectively, very structured. Maybe the last hour of the trading day, somewhere in the 3 to 4 o'clock time frame. And then also place those on the website so that they're all organized. And so now you have the 3 videos for last week and the week before and the week before that, and then they're culminated by the retrospective. So each week we'll then have 4 videos that are essentially reviews of the individual processes and then the overall process. So what do you think about that? So let's see, we got some comments here. Ahmed says, so far so good. Hello, hi, how you doing? Hello. New to the room. Lawrence is new to the room. Ernie, does I am butterfly or butterfly? They're exactly the same, really. The only difference is one uses only puts or calls. The other one uses puts and calls. We do use out-of-the-money butterflies. Yes. That's how we get the kind of risk to reward that we're looking for. We're generally looking for at least a 1 to 5 risk to reward. That's one of our guidelines, and that seems to have worked well. Sometimes we can get much better than that, but if we get less than that, then we don't take the trade. So calls or puts. Generally, if we're going to do a butterfly, then if we're taking a bearish trade, we're doing puts. If we're doing a bullish trade, then we're doing calls. And the reason for that is so that we keep it out of the money as opposed to in the money. Now, to me, this really doesn't make any difference, but for some people this does, because they're very concerned about maybe trading the E-mini and being in the money, and even if the trade doesn't go into the profit tent, being in the money will mean that they potentially will get assigned. But there's a potential for getting assigned no matter what. So for me, it doesn't matter. You could use calls or puts. It doesn't matter. What you should be concentrating on is not allowing yourself to go all the way to expiration in order to be subject to being exercised with a futures contract. That seems to be like a no-brainer. But For some people, that just seems to be a bugaboo with them. Let's see. So they are debit directional trade. Right. Now, we could put on a broken wing butterfly and it could have a credit too. So there, the thing with the broken wing though is that you are putting yourself a little bit at risk with the far side of that trade. You might have a credit on one side, but then a big debit on another. And if price does make a very large move, like a 2 or 3 standard deviation move, you could be subject to the risk of that wider spread. These are all things that we've talked about in the past, and we will continue to talk about them. But what I'm trying to do here today is establish a way that we can record all of these things so that we can then reference them and then build up data over time so that we can talk about them and learn from them. All right. Let's see. NSC 212, great name. When you create multiple butterflies, can they have some legs that have matching strike prices? Very rarely do we do multiple butterflies in the same trade. So we do have one instance where we've created what I call the Batman trade, where we flank price with a butterfly in a bullish position and one in a bearish position, so that you have basically, 2 Batman ears. But that's very rare, and it's only because of maybe a mid-market reversal, right? So, but usually we just put on one trade and then that's it. And we either live or die by that trade. Now you can put multiple positions on, and you might even put multiple positions on that are maybe staggered by a strike to increase your probability of profiting. Or you just put on one position with multiple positions with the same strikes, whatever, floats your boat. I do not have a standard one way or another. Got a little dryness in my throat for some reason. The coffee wasn't helping. The water helps. So let's see. Sounds like a great plan. Thank you. Brian asks, if I am unable to get out of the butterfly trade near end of the day to avoid assignment, is the best solution to get out of the short legs? I have a small account of 5K. If it's a futures trade, it won't make a difference, because if you have just either a long or short that's in the money, you can get assigned. Now, I'm not sure exactly why you couldn't get out, right? If you can't get out, is that because of work-related things or something like that? Then I would just make provisions for getting out, right? If you think that you're going to be tied up and can't tend to the trade right at expiration, then you should be prepared at the end of the day to be able to handle the assignment that you may be potentially coming up against, or just make it easy and just get out early. I don't have a clean answer for that, because that's like an edge case for most people. Like, if how do I modify my trading rules for somebody who's working? I don't know. Let's see, Ahmed, do you break the legs or hole in hole out? I think what you're asking is, do we modify the trade or do any kind of adjustment? The answer is no. And the reason for that is that we put on asymmetric trades for a very specific purpose, by defining our risk and making the risk very, very small compared to the potential return. That is our money management in that defined risk, and we're willing to take that, right? So, for instance, if we're putting on these 1 to 10 trades where our risk is, say, $75 and we're looking to make $800 or $900, we're not worried about the $75. So we're not sitting there trying to figure out, well, how are we going to save the $75? We're putting all of our effort into how are we going to make the maximum amount of profit as price moves towards our goal. And, can we extract $100 out of this, $500 out of this, the full pin trade? I don't know. Or maybe nothing, or maybe just a partial loss or gain or whatever. But we're not sitting there worried about the risk that we take. And in fact, that is part of and a purposefully made risk that small so that you don't have to worry about it. The whole point is that you don't want to experience the anxiety that you experience with low delta strategies where you have huge risk on the wings and you're going after small profit. We're doing what I call the inversion of risk, where we put on these asymmetric trades that are in our favor so that we don't have to worry about that, so that we can make clear-headed, non-anxiety-ridden decisions. Let's see. So you are directional. Of course. It's very rare. Now, even with a trade or a day that is range-bound, you're still directional, and you can still put on an asymmetric trade. The market is always moving some amount. There may be a very minority of cases where the market doesn't move, an extreme minority. So no matter what, we are, yes, directional, trying to figure out where the price is going to end up, and then that's where we're going to put our premium collection device. Sometimes the market moves way more than what we expected. As evidence of the last couple of days, it was just totally off the hook the past 3 days. I don't know how you plan for something like that, but we put on one trade where we had the direction right, but price just went right through it. But there was plenty of opportunity to make profit as price went through our butterfly from one side of the butterfly all the way to the other. Some people are waiting to think, well, maybe it will come back and we'll pin it again, instead of just taking the profit when they could have. Sometimes a trade will make it halfway towards the butterfly, never entering the trade, but you still have the potential to take 100 or 150% return on your money. But again, some people might wait and say, well, it might continue and go into there, and then it retreats, and then they take a max loss instead. So these are things that we need to review, and review your decision-making process so that you can improve that, so that you can be more apt to take that profit when it's presented to you, rather than wait and hope for, getting the pin trade. And this is, I think, the primary problem with some people. Some people are trying to get cute with scaling in and scaling out, and maybe doing something that I had suggested, but doing it in a way that is too risky or not efficient, right? Or not purposeful, and just trying something and then not having a good result. So so for instance, if you're going into a trade with multiple positions and we move towards the butterfly and there's an opportunity to take off maybe 3/4 of the positions that guarantee you a profit, that's probably a good idea. But maybe they don't have that in mind, or maybe they're not thinking that way, and they just try to scale in, further and further, then scale out without a real plan. So again, that's what doing these retrospectives is about, and what I'm proposing, this new ceremony, a daily ceremony that we do, where we record the what happened in the trade and create an objective accounting of what happened in that trade in a very short video at the end of the day, so that we can review things like that and get better as time goes on. Again, sort of implementing that continuous improvement process, but bringing it down to an even smaller iteration. So we have a small iteration within the big iteration. All right, David says, the videos will be a good learning and accountability to ensure the process is learned in real time. Yeah, I agree. Yoder, How do we determine the Goldilocks zone on VIX? I'm sure this has been discussed before. I have missed it, and I am somewhat new. So that has been discovered over time, and just the quality of the market when the VIX is at a certain level. I don't believe that there is any specific occurrence or delineation or whatever, at VIX 17 versus 18, all of a sudden everything falls apart. No. What I have noticed is that our performance improves when the VIX is somewhere between 17 and 34. That's when we have optimal performance. If I just go back and look at all the trades and map it to where the VIX is. When it's lower than that, we tend to have fewer trades and slightly lower win rate. When it's above 34, it becomes very tenuous and very difficult, and often we have fewer trades and lower win rate. Sometimes big wins, but so it just seems that there's some sort of entropy that exists at those levels that have been discovered through just trial and error. Now, less than a year's worth of trading isn't a great deal of time and a lot of data to be able to make that determination. But for me, I've actually made that determination apart from just this strategy, but from other strategies where I've been trading options for the past 30, 40 years, where I've come up with that zone as well. And it seems that zone has some relevance, and it seems that it has particular relevance in the last day of expiration. So the Goldilocks zone is somewhere between 17 and 34. If you were to break it down even further, I would say, between 24 and 30 seems to be really super, super good. That's where we have our most consistent over time. If you took the aggregate of all the trades that happen in that time frame, in that zone, they seem to work out the best. Doesn't mean they all do. It just means that the aggregate over time works out the best in that area. All right. Stop loss. No stop losses. Why are we doing stop losses when we're already defining our risk with asymmetric trades? That's the whole point. There are no stop losses. I can understand if you're taking huge risk and low delta trades, why you would need a stop loss. Although I can't understand why you would take those type of trades. Or why you would need a stop loss when trading options at all. The whole point of an options trade is that you're defining your risk. You're modeling something and putting on defined risk. Defined risk means just that. You're defining what you're willing to risk. It is the stop loss. A stop loss is definitive. You hit the stop loss, you lose the money. You define a risk, and it can come down to that defined risk, but you don't lose anything until you've exited the trade. It could come back and you could end up winning again, which has happened several times with us. So there is no stop losses, period. Let's see, Brian's saying, in case I cannot get out of due to a lack of open interest. Now that's a different problem, all right? That's what we call a liquidity trap. And liquidity traps, I would say, are things that we need to learn how to detect as potentials, and that's when we have a complete absence of liquidity for that day for whatever reason, market conditions, and also that we can minimize by the placement of trades so that we are working with strikes that have a lot of open interest. If we don't work with strikes that have a generous amount of open interest, then we could potentially get into a liquidity trap. But then there are just sometimes environmental conditions where the whole market is experiencing lack of liquidity. And no matter where you put the trade, you're going to experience this liquidity trap. And we experienced this actually in January. And if you were to look at the overall market liquidity, it was or is or very close to its low recently in the past few weeks. And so I think that, that's why we were experiencing these liquidity traps. Is there an answer to it? The answer is that once you're in it, you're in it. It's like being in quicksand. How do you, what is the answer for once you're in quicksand? I don't know. Exit with a loss, or just wait it out until the end of the day and hope that you get a max loss, which is less than the loss you would have taken while you're in the liquidity trap. Although experience all the frustration that you're sitting there right in the middle of the butterfly and you're seeing no profit. I mean, it's crazy as it sounds, but it happens every once in a while. So let's see, Lawrence is asking, so as it glides through the strike, you can take profit. Let's see. Right. Okay, so I'm reading all these questions, and there are multiple conversations with me going through. All right, so you're very welcome for those questions being answered. So so let's see, how are we doing on time? We're only a half hour into this. Wow, it's amazing. All right, so this past week was a crazy week in the market. We had, every single day, we had opportunities to take profit. Now, some people did, and some people did well, or marginally well, or at least positive for the week. Other people experienced a max loss each day. Fortunately, because we're taking the defined risk, then those max loss amounts are relatively contained, right? Depending on how big your position sizing is. So, but the potential was there to profit every single day. And so that's what we want to get to. We want to be able to take that potential. Even in a difficult market, I think this strategy is strong enough that potential exists where you should either lose very little or have a potential to profit, even though it's a difficult market, or if it ends up that we place our trades correctly, potentially make huge profits. So for me personally, I was, for the week, I averaged about maybe 70% profit above my risk, including commissions. It's not a huge week, but compared to other types of strategies, that's like an enormous return. 70% on your risk, that's crazy. But for us, that is like a little bit below average in the long run. Usually we're getting 150 to 200% return on our risk. But what can you expect in these types of markets? This market, in terms of its movement, set some records in terms of single day moves, right? So these are so outside of the normal distribution of potential trades that they aren't things that you can plan for. They are things that hopefully your strategy will allow you to react to and maximize. And again, by keeping our risk very small, even when we're experiencing these outrageous moves in the market, they still shouldn't invoke any kind of anxiety because we're not putting up a lot to potentially lose. So we can be in awe of the move and we can look at it rationally, and because we don't have any anxiety, make some clearly or clear-headed decisions. That's really kind of the point of the strategy and the process that we have, so that when we encounter weeks like this, that we can think about it rationally and make good decisions. Sometimes, there are no good decisions, and you can just look at it and say, wow, that was just an unbelievable week, right? What do we do? Well, we really couldn't do much. I mean, you can't anticipate that you're going to get a 200-point move in the market when you're expecting a 40-point move, right? I don't know how you come up with a strategy that is so flexible that allows you to do that. We could modify our strategies a little bit. So, for instance, if we think that there could potentially be very large moves in the market, with a butterfly, you could get creative. Instead of doing a 1-2-1, you could do a 1-2-2. So on the tail end of the butterfly, you have this, unlimited profit potential. But what that's going to do is that's going to increase your risk on the front end of the strategy. But it's just, it's kind of like a poor man's long. It more strikes, more contracts, but it gives you a little bit more flexibility in how you can derive profit for the day. So we can look at things like that. You can look at things like uneven wings in a broken fly. You can look at an unbalanced fly where you do something like unbalanced wings where you have maybe a 1-3-2, that's, or a 2-3-1 in it, depending on what direction you're coming at with the butterfly. All of those things provide different kinds of growth of the premium decay in the short period of time that we're in that trade. So you have to remember that, the shape of the butterfly is not the shape that you're dealing with during the day. It is the shape that the P&L is moving towards, right? So that P&L, depending on where you are and how that butterfly is constructed, is either going to be symmetrical and grow like this into the butterfly, or it's going to be bulbous like this and then grow into the butterfly, or it's going to be, sometimes it does like a tooth thing, depending on the shape of your butterfly. It's, it's growing as premium is decaying. And so that's what we're actually playing. And then the other thing that sort of comes into play is, what is volatility doing during the day? Is volatility rising or is it dropping? So in general, a butterfly is what's called a vega negative and theta positive trade. Vega negative means that when volatility is dropping, or vega is negative, the rate of volatility is going down, that premium tends to inflate faster, or premium tends to decay faster, or upfront. So the earlier parts of the day, you'll get a symmetrical fly will fill up faster instead of waiting. Sometimes when volatility is going up, then premium tends to be a little slower. It's because it's vega negative that is negatively affecting the rate of decay. So those are all things that you have to consider. And those are things that you have to watch, right? So what we're really playing is that like in Thinkorswim, you have the premium line, right? That curve. And then you have the butterfly. Now what I should do is I should maybe illustrate this on the iPad and see if I can bring that up. Let me do that. New movie recording. Might have to reset QuickTime here. So does all that make sense to you? In terms of, see, taking profit is all about where we are along that premium curve that is continually decaying or increasing as far as we're concerned during that day. Trying to get my iPad to recognize, or trying to get QuickTime to recognize my iPad. I don't know why it's not. Let's try it again. There it is. All right. Then I just go over here and I add it. No, that's not it. All right, QuickTime. There we go. All right. So I've done plenty of these things. Like this is sort of kind of like what I'm talking about. You know, the cyan line is the butterfly at expiration, and the purple line is the premium as it grows. And here I'm actually showing a situation where we have a liquidity trap where premium kind of became concaved instead of convexed. And during the middle of the day, we could be sitting right here, and instead of being in profit, we're actually in loss. And that happens every once in a while. All right, so let's go back here and I'll start a new one. All right, and we'll look at a standard. Let's say that we're right here. This is at the money. And after examining the market structure, the volume profile, you know, we might have, I don't know, a profile that looks like this, and then there's a big node right here, right? And we think that price, you know, price is here, but we think that it's going to go in this direction because of some economic report. And so it's going to head towards this volume node, right? And then as you know, that when we do the market structure, I put boxes that outline these volume nodes like this. These lines are showing support and resistance, so that price is going to try to go into that volume node. It's coming through this volume well area that's right here, and it's going to try to go into that volume node. It's going to find some resistance when it comes right to the edge of the node, but once it gets in, it's going to tend to be, you know, go back and forth right there. Sometimes in unusual markets, it will go right through it until it gets to the, maybe this is a volume well and this is the low point. It gets to another volume node up here. That's an unusual situation. But generally, we try to find the next volume node where it's going to go and where we think it's going to stop and consolidate. So what we'll do in a case like this then is put on a trade that will look maybe something like this. Oop. A symmetrical fly, and you know, its center may or may not be somewhere in here. Sometimes we'll position it here, sometimes here. You know, we don't know, but it's going to be something like that. And what we're showing here is that the risk to the potential reward is asymmetric, maybe 1 to 10. All right, so there's the basic setup. If you can make sense of that as I drew that. So we'll go back and we'll create another cleaner version of this. So we're right here at the money. We'll put on the butterfly. When we start out, the actual potential profit, or the P&L line, if you look in your platform, will look something like this. Right? And usually when you put it on, you'll be right at the break even at that time of the day, and then there will be another break even over here. Now we're suspecting that price is going to move in this direction. And so as price moves in that direction, we'll be climbing that P&L. As the day progresses, that P&L is going to start growing like that. Sometimes the growth will be weighted on this side. Sometimes it will be weighted on this side, depending on the skew of the market. Our ideal situation would be that the day ends up right here, and then we get something like this, and we maximize our profit. But even if we end up out here, we can still profit, and profit handsomely compared to the amount that we could exit the trade at compared to the risk. As a matter of fact, out here, we can often get anywhere from 50 to 200% profit, or 200% return versus the risk, without ever even entering the profit tent, as they call it. Now, what happens with some people is that they'll hang out here, and price may be, say, right here, and instead of taking the profit right there, they'll wait thinking that it's going to continue into the profit tent for hopes that they're going to get more. And they may be sitting here with 70, 110, 160% return on their risk, but to them it's not enough. They want more, or they expect more. And so instead of retreating, they'll stay there, and then price might reverse, and then they end up not making anything. So we have to look at those types of situations and examine them more closely, and then come up with strategies on how we would capture or realize the profit that we have in hand, or stick to it if we think that there is a very good expectation that price is going to move into the profit tent and potentially give us more profit. Now, you can take a multi-tiered approach to this. If you had multiple positions, and let's say you had 5 positions, you could take 3 of them off and guarantee yourself a profit and leave a couple on, or maybe take 4 of them off and leave 1 on with the hopes that it might go in and get pinned. That way, even if price goes all the way back and reverses on you, you're still a winner, right? So, but that ratio of trades can be significant, and the choices that you make at specific times is also significant, and also reading the market in such a way, or whatever the volume profile underneath, or whether or not there is max pain, at this point or over here. New news comes into the situation. Again, it's a free-flowing system. We don't know exactly what's going to happen. However, we can learn from each individual case, and we can get better at taking early profits and then leaving ourselves open to making larger profits. Some days it's almost a no-brainer. It moves right into our max profitable area and just stays there all day. And that's happened to us many times, and we've pinned many trades and made lots and lots of money. And then there are other times it approaches our profit tent and then does an about face. Or very rarely do we get direction completely wrong and it never even goes there. As a matter of fact, if you've been with the service long enough, you know that those cases are probably 1 in 20. Very rarely do I get the direction wrong or the magnitude wrong. In other words, it will go there, but maybe the timing may not be conducive to us. So all of these are factors that we have to get better at and that we can evaluate. And as long as we keep our risks small, they're not, if we make bad decisions at first, they're not going to hurt us. But that's the key, keeping your risks small. Let's see. So we can have less than 50% one. I'm not sure what this. The words are getting confusing there. One, rare and stall be green. Still be green. Okay. One and still be green. Yes. So in other words, you don't have to enter the you do not have to enter the profit tent of the strategy that we've placed there in order to make money. As a matter of fact, you can make a very good living at having 50 to 100% returns if that's what you're after. As a matter of fact, when you have a small account, that's what you should be after. And every once in a while, the big returns are going to be no-brainers, even with a small account. You won't be quick to get out. You can tell by the nature of the day or the positioning of the volume profile and how price is moving that day, if it's trending or not, or if it's grinding or not. So you can put yourself into position to potentially make a lot, or if you think that there's a question on whether or not it's going to make it all the way and give you a high percent win, you just get out. Just keep in mind this, that in reality, even if you're able to keep in every trade, we're only going to pin trades about 10 or 15% of the time. When volatility is increasing, though, we tend to get into that near pin trade situation more often. All right, Brian's asking, what is the expected profit on the outside of the far right side of the tent? That happens very rarely. And I would say that those are usually 2.5 standard deviation moves. So those are about 5% of the time. But even if that does happen, you have ample time to take profit while you're moving through the tent, and you even have time to take profit when you're on the other side of it. But there have been cases where we have moved completely on the other side so fast, and it was just ridiculous. And this past week was one of those cases. However, there was a trade that happened on Wednesday, I believe. We went through the profit tent so quickly, but while we were moving through it, there was a chance to take about 110% return on your risk. Then it moved straight through, and the trade was completely gone after that. I guess some people might have thought that it would return, and so they decided to hold on and then make no money. So again, it comes down to your experience and your decision making at that time. All right. So enough of that. I think I don't want to go too deeply into it. I think everybody or most people will understand what we're talking about here. And we'll go back to the big head. That's this guy. All right. So let's wrap everything up here. We're getting on to about an hour. So the big changes for us, now that we've gone over the strategy and what we're really after, how we're going to come about making these decisions, is the big change for the overall strategy now. I'm going to create a separate channel. Excuse me. I'm going to create a separate channel for recording the day-to-day analysis or the day-to-day recap. So it'll have nothing but videos in it. Right? So I'll do the video, I'll do a live YouTube stream, and then I'll link it and I'll place it in that channel. So then we can go back and review all the reviews, the daily reviews of the trades, and they'll be short. I need to come up with some sort of structure for those trades so that they're very objective. They're all about the same length, maybe 10 minutes or so, 5 minutes, 10 minutes, something like that. Something that's very digestible and goes through and looks at each part of and grades the analysis, the catalyst, if there was one, the modeling of the trade, the placement of it, and the execution of the trade, and then the profit-making strategy. So something like that. So maybe it'll be split up into 4 parts, and it will be graded with a small comment. And then we'll, and this, again, that'll probably evolve too. But let's try it for now, and then at the end of each week, then we can look at the 3 reviews that we had, and then we can discuss them, and then come up with some more qualitative ideas on how we can approach those different market situations. All right, so that's the direction we're going to go in. I'll try to come up with a format for that. If you have ideas for that format, please go into the Discord and start a discussion around it. But I think it's going to be a major change to the service and a major plus to what we're doing. And a really great learning tool. Thanks, Jack. All right. That's about all I have to say. I hope this was useful for you, and you're getting a lot out of this. If you're a trial member and your trial is coming to an end, even if it's not coming to an end, you might want to consider one of the memberships. I added a quarterly membership for some people that might be interested in that. So now there's monthly, quarterly, and yearly. About 70% of the people take the yearly, and I'm extremely flattered by that people have that kind of confidence that they want to stick with the service that long. And I encourage you to take any of those. There is a discount for the quarterly. I sent out a special discount for the quarterly in email, so if you want to take advantage of that. The discount for the yearly, or for monthly or yearly, is 4 weeks back. It's actually the number 4, the word weeks, and then the word back, all concatenated together. So that will give you a rebate that will rebate the entire cost of a 4-week trial. And so, if you want to do that before the month is over, I'd appreciate that. I like to get those monthly totals in and then start the next month. All right. So everybody, I hope you have a great weekend. Thank you very much for showing up. Peace to you and your families. And we'll see you. Well, you'll see me tonight. I might be doing an analysis tonight. This is going to be a very exciting week, I believe. A lot of people are looking at maybe a continuation of whatever that was this past week, this unbelievable move off the bottom. I don't know if that has sealed the bottom for the current move down, if that was the correction or not, or if somehow this was some other kind of thing. I really don't understand it. I don't understand it because it's never really happened before in my trading career, anything quite like that kind of move. Or, it hasn't happened in decades. So we'll see how it all goes. All right. Take care. Now I have to find that off button. It's way up there. There we go.